What's good, traders? Let's talk about inducement. Now, before we understand what inducement is, we have to look at this diagram first. Let's understand that inducement is also liquidity. So let's look at this diagram. So we have a supply and we have a possible entry right here. But why is market going to this spot again? To give you another possible entry right here, which will eventually take the market to its destination. All right, this is a supply zone here, and we anticipate that the market would go to this supply zone and give you a possible entry to this spot. Let's say there's a previous low here that market wants to reach. You see that the market did not reach this particular low right here and went up back to give you a re-entry. So this right here is what we call our inducement. Now, looking at this, in our previous videos we have finalized and understood what we call fair value gaps and mitigation blocks. So let's say we have a mitigation block here and we have a breaker here, or let's say we have a fair value gap here and we have a breaker here. Now this is a possible entry for people that want to enter bearish on this zone, right? So we have a possible entry right here. Let me show you. We have a possible entry right here, and you might want to put your stop loss here because we have seen that market has come to this spot right here and is not willing to go above this consequent encouragement, which is the center of our fair value gap, and you put your stop losses here, right, just a little above the middle or the center of your fair value gap, which is the consequent encouragement, and you take it to this previous low right here, assuming we have a previous low right here. Now you might be wondering, after you have 8.9 risk to reward, you see that market rallies down, then goes up to take you out. Just know that you have become that inducement or liquidity. So this is an inducement here. This is an inducement here. In my term, I call it the younger brother, because this younger brother comes to test the market out if it's actually going to make it go bearish or just rally to the upside. Now, since this one is like a confirmation to me because it's a previous high on its own and it has not fully filled this fair value gap, so I want it to tap into that fair value gap and give me a first entry, but I won't enter, I won't take any trade here. So I call this one the younger brother right here. So let me write it down. So this is the younger brother, all right, which is also inducements. Okay, so this is the younger brother right here, which has come to test the market, right? We now wait for the market to be tested. After it's been tested and other traders putting their stop losses right above this inducement, then I wait for the market to come back as the elder brother. Then I put my stop loss right above this fair value gap right here, the high of this fair value gap right here. Then I wait for confirmation and I enter, right? So, and market reaches my destination. So that is your inducement. The first entry is your inducement. So you can use that as your confirmation. So let's go to the chart to find out more about this inducement. All right, we have one here. Since we have a bullish order flow, which is the market structure going bullish, we see that market comes back to take the liquidity, and this liquidity is right here. I have marked it before, so it is right here. The market has taken liquidity and rallies to the upside, and market going back to the upside gives you what? A fair value gap. Now this fair value gap, market coming back to it, fill this fair value gap, trying to go up, right? And you see another fair value gap here. But this market trying to go up gives you an inducement. Since market is not giving a reaction that it wants to go up from this fair value gap that it has created here, the market now comes down to take out this inducement, this previous low, but still in that fair value gap high, because this high has been created. So this is the fair value gap high, and we now wait for the market to give you a reaction here. As market has given me this reaction, then I enter, and I expect the market to rally to this point right here. So let me give you the projection. All right, so after market has taken this inducement, then it gives me a reaction, and I look at the reaction as a possible entry. Why some people will enter here and thinking that the market is going to go up and not come down because of this fair value gap, but they were wrong. And it is better to actually put your stop losses right below that previous low that created this fair value gap. So since market has taken this low as its inducement, so I look at it as, okay, there is a reason for market to go up since it has given me a reaction here, and I enter at this spot right here and put my stop loss right below this previous low here, and my take profits right above here. As you can see, our market went to my take profits, giving me was a 4.5 risk to reward. A 4.5 risk to reward. So you can see that inducement is quite helpful in your confirmation of entries. Let me show you another reason. Let me show you. Okay, this is on a 5-minute time frame. Let me show you one on a 5-minute time frame. All right. So now we have a low that has been taken right here. This is a previous low that has been taken right here. This is a previous low that has been taken right here. All right, this is a previous low. You see how market takes this low. All right, let me take this one out. You see how market takes this low. Let me be certain. So let me be certain that market has taken this low. Market takes this low. Why we are on what? On a bullish trend. Market takes this low right here. Creates what? A fair value gap. After creating this fair value gap right here, you can see that market enters into that fair value gap and created a reason to enter. Okay, you want to buy here at this spot when market has created a reason for that fair value gap. So most traders will likely put their stop losses here. This is another reason for you to put your stop losses to this extreme here. So most traders will put their stop losses here and put their take profits probably at this fair value gap here, or this high here. So you see that the market has tapped into their fair value gap and rallied to the upside, but because that serves as the first entry, which is their younger brother, the inducement, they are being taken out here. So it is quite better you put your stop losses at this end here, and the market will just likely come back and take you to the take profits here. But because you didn't put your stop losses at the extreme, that your first entry now seems to be your inducement, which you should have waited for, because the price did not fill in that fair value gap right here. So since market taps into that fair value gap, and you should just wait, and when market comes into the fair value gap again, you now have an entry. You see how market taps into it. While going back, you just enter, and market takes your trade to to this end here. You see how market takes your trade to this end here. So that is another trade on its own. All right, that is the second trade. So let's look for another trade right here. Okay, so we see this trade as a liquidity also. This is a liquidity, right? This is liquidity that has been taken. What we need to look for is a reason to buy. Now I'm looking for a fair value gap. Now there's no fair value gap here. There's no fair value gap and reaction here. There's a fair value gap here, right? But it is not enough because it has been filled and market taps into it. You can see it right here that this fair value gap has been filled already. So there's no reason for me to enter again when market taps deep into it. So this low has been taken also here, and you see that on a higher time frame, which is your 15 minutes time frame. If I go to the 15 minutes time frame, I will see that market gave me a very strong fair value gap, because like I said on other videos, higher time frames are quite powerful than lower time frames. If you can see your fair value gaps on higher time frames like the 15 minutes, 1 hour, 30 minutes, 4 hours, they are quite stronger than the 5 minutes and 3 minutes. So this could also be seen on my 15 minutes time frame. But look at this. This is a fair value gap, right? And you can see that we are on a bullish trend. That is the first thing you need to look out for. Your fair value gap and you are on a bullish trend, which is your market structure or order flow. Now we see a fair value gap on a bullish trend. What you need to look out for, as any liquidity been taken. Now liquidity has been taken and market is trying to go up. So since this fair value gap has been spotted at this place here, from this we can see one fair value gap, we can see another one. All right, then we can check for any liquidity, which is our inducement in this case. Now this is one inducement that has shown itself here. Most traders want to enter here, right? Let me show you example of how most traders enter. Since they want to protect their funds so well, they want to put it here. Traders put their stop losses here and trying to protect their funds, and they take their stop loss to the consequent encroachment of that fair value gap. And see what market just had to do. Market had to, okay, fine, we want to take our trade to the previous high, giving you how many risk to reward? Giving you a 3.5 risk to reward. That's quite good. That is good. But most traders put their stop losses right below this spot after entering here. So they enter here, they enter at this spot, then market takes them up, thinking, okay, market want to go to that destination. Bear in mind there is a fair value gap here, which serves as a barrier for market to reject. Now there is a fair value gap here for market to reject that price going up. You see how price went up and was rejected. That's what you need to look out for also. So when price rejected that zone because of this fair value gap here, you see how it went back and took out this liquidity, which is our inducement. The first entry is quite risky to enter with. So the price takes out this liquidity, which serves as our inducement, and takes out the people that entered here and put their stop losses here. So what you need to do to prevent this kind of case is that you wait for market to come with its younger brother. As I've said before, I call this the younger brother. This is liquidity right here. This is liquidity right here. This is liquidity right here. After this liquidity has been taken, you see a beautiful entry. this is when you can now enter the market and put your stop loss right below the previous low, and market gives you your beautiful 3.5 to 3.6, or even 4 points, as you can see, 4.35. all right, that is one reason to enter there after market has given you that younger brother, which is your inducement. all right, so this inducement happen in most cases, but cases like this, you can see the market has taken this. You can see another trade here. Market has taken this previous low, and what market gave you a reason to buy here because of this fair value gap. There is an inducement here, but we can't find it. This is the inducement here. Market has taken this inducement. This is the younger brother right here. Went up, now market goes down and took out this inducement. Fine, and rally to the upside, creating another reason for you to enter again, which is another fair value gap, and you can enter again. But you can see this inducement has been taken. This is hidden in plain sight. You can see that market rally to the upside after taking out this low, then created a fair value gap. Let's look at this. Let's look at how many risk to reward that is. all right, so our previous low is this, giving some room to breathe, and this is our previous high. This is a 5 risk to reward ratio, or you can take it. You can see how market took the price to this spot, giving you a 15.4 ratio. all right, but in most cases I would likely put it as a 5.03 ratio. all right, so let's look at another inducement. This is another inducement on a 5-minute time frame. Now what do we have here? Market took this liquidity right here. Went up, created a fair value gap. After creating this fair value gap right here, it gives you what? An inducement. First off, this is an inducement on its own, but we want an inducement right at this zone here. So this is the first inducement. After market has given you this inducement, you might want to enter here. Most traders will likely enter at this spot, and it can give them a 1:3 risk to reward ratio, or they might want to aim for a 1:5 or 1:10 risk to reward ratio. But in this case, let's look at this. Okay, if you were aiming for a 1:10 risk to reward ratio from this supply zone, you might be looking at this as your breaker, right? So you might want to put your stop loss at this spot. You can see the market went up, almost reaching your destination or your take profit, giving you a 1:10 risk to reward, as you can see right here. But market went up, probably giving you a 1:7. Let's check it out. Okay, 1:8, and your aim is 1:10. But because you didn't wait for that younger brother to be taken out, now market takes you out. You see how market gave you another entry, but this is a double bottom. So all these equal lows and equal highs, market tends to take them out. So this is a relative equal lows right here. As you can see, this is a younger brother standing right here, and you wait for it. Then when waiting for it, you see that market takes out this younger brother right here. As you can see, market takes out this younger brother right here, and that one went to the destination of your 10.3 risk to reward. You can see how market takes this younger brother here and went up. That was just quite the deal, because most traders just use the younger brother instead of waiting for the elder brother right here. So let's look for other reason for you to enter using your inducements after the inducement has been taken. All right, so we have a breaker right here, we have a fair value gap right here. All right, this is where most traders will likely enter. This is where most traders will likely enter, and this is your fair value gap right here. All right, so looking at this, you can see that most traders will likely enter from this fair value gap right here. But because we understand the value of using your inducement, you will not enter here. You wait for market to take this one out as the liquidity, then you enter from this spot and put your stop loss just below this spot. You see how markets could give you a reason for you to enter here. Put your stop loss here. This is even on a 5-minute time frame, as you can see. If you want it to be a 1 to 5 risk to reward, why not? You have a 1 to 5.4 risk to reward. So that is your inducement. We have other reasons to enter using inducements. Are quite powerful because you have to wait for market to give you a solid reason or proof that market is rejecting from a particular area. Like this, you can see this inducement, you can see this inducement right here, you can see this inducement. This is also an inducement. This is a fair value gap. Now market taps into it. This is a breaker. Market taps into it after this low has been taken, and this is inducement has been spotted and taken also. Market taps into it and rally to the upside. You can see another inducement here. This is an inducement. This is a fair value gap. This is another inducement right here. Market taps into the fair value gap after taking this inducement and this inducement here. You can see that market taps into it and rally to the upside. So when you are trading with this market structure or order flow in check, it gives you a more risk to reward. Even when you are trading on a downtrend, but that market structure is giving you a bullish trend, you can also cite opportunities as this one. You can see that the market has given you a fair value gap right here. This is a fair value gap right here. This is an inducement right here. This is an inducement. Market tested that fair value gap, went down. Okay, this is a good fair value gap to trade with. Now market uses that fair value gap, taps into this order block right here, this bearish order block, and rallies to the downside, takes out this liquidity. There are many examples using inducements. There are many examples using inducements are quite good, and you have to just be familiar with them. You can see one inducement here. This will be the last inducement we'll be working with. So this one I wanted to show you guys before this video. So this one is one inducement on its own. You can see that we have a breaker, right? And this high has been taken. This liquidity here has been taken by this high, and market rallies down, created a fair value gap. After creating this fair value gap, you can see that the market taps into it, taking out this inducement. You can see the market takes out this inducement. Let's go back to our 15-minute time frame so we can look at this inducement. All right. So working with inducement, you can see how powerful they are when you do not enter as the younger brother. So basically, this is what we're looking at on the 5-minute time frame. Now on the 15-minute time frame, you can see clearly that there was an open space here, which is the fair value gap, and this is the supply zone. You see how market comes down to this supply zone. So fair enough, we can use this as our inducement here. This is our inducement here. market taps into this inducement many times, giving you reasons that, okay, I'm trying to go down. These are quite a number of rejection blocks right here. So I'm trying to go down, but this serves as what? As inducement on its own. Inducement on its own. After giving you that reason to enter, people might want to enter here. People might want to enter here and leaving this place out, but because we understand the value of inducement, we do not enter here and we wait for market to take out this liquidity, this inducement liquidity, and put our stop losses right above the previous high, which is this one here. So you see how market taps into it and rallies to the downside, giving you a 1 to 6 risk to reward. That being said, this is also seen as a liquidity on its own. This one here, this one is also seen as an inducement. Okay, looking at it, this fair value gap was not filled. This is an inducement tapping into this previous breaker block here. After market taps into it, we can also see this as a younger brother. Now we wait for the elder brother to tap into it and take out this inducement. So you can see here that the market taps into this fair value gap, takes out this previous high, which is our inducement. Let me write it here. Alright, so this is our inducement, and you see the market takes out this inducement, taps fully into this fair value gap, and what gives us a reason to enter, and we have a 6.6 risk to reward ratio. So bear in mind that using the power of inducement can actually serve as an added advantage to your confluences, because when you make use of inducement, you need to have more patience in working with your entries. After an inducement, you call that your younger brother, then you wait for the elder brother to take that younger brother and rally to the downside or upside, as the case may be. Alright, so that is all about inducement. So feel free, check your charts for inducement before your fair value gaps, and like, subscribe, comment. Peace.